Hey everybody, this is Shamika. Please like, subscribe, and share my videos. I appreciate you guys' support. I am going to talk to you today about the 5 components of your FICO score, credit score, Vantage score. They all take the same information into account. Although the percentages may be different, all 5 categories are the same. The 5 categories are payment history, new credit, amount of debt, credit mix, length of credit history. Everybody's credit situation is different, so everybody's applicability to all of these is different. It may be 5 categories, but if you only have 4 things that they can pull from your credit, the percentages change. The biggest portion of the 5 categories, or shall I say the pie, the biggest percentage of it is your payment history. That's 35% of your score. All right. So you get your payment history from accounts that report on your credit report. If you look on your credit report, and we could talk about Credit Karma because that's usually the one that people have. It's free. Your payment history or your past payment history on Credit Karma should show, or even on your credit reports, it will show the past 24 months of your pay history. Okay, so that's where they get it from. But did you know that your payment history comes from store cards like your Walmarts, your Target, credit cards, your Visas, American Expresses, MasterCards. They also come from installment loans such as a mortgage, your student loans, your car loans. And it also comes from finance company accounts. So if you're an individual, you're shopping for a personal loan and you decide to go outside of your bank and you go to one of these companies like lendingtree.com and they shop your information around and you get hooked up with this such and such finance company you've never heard of, that is where the finance company accounts will come from. And a lot of people don't know this. If you have a public record, whether that's a bankruptcy or a tax lien, anything like that, your payment history also is affected by that. They actually take that into account. Although there is no monthly breakdown of your payments, the banks will know, if I see a public record, this person's had a problem making payments, period. All right. So they do get payment history from that as well. All right. So in the payment history, banks want to know 4 things. How late was this payment? Was it an isolated incident? Is this something that does not happen often? In your past 24 months, were you only late once? You only got one 30-day late. Banks will say, okay, well, not bad. We can still probably give this person a loan or give them a credit card. They only have one 30-day late. Then they say, well, how recently did this occur? Now, they ask that because, remember, banks like to work on the 90-day cycle, right? Every 3 months, that's when everything is reviewed. It pretty much starts over, or they look at an average of what you did for the past 3 months and come up with stuff. So they want to know, did this 30-day late just happen, or was it a year ago? Now, I would suggest if you're going out to get a loan or a credit card, you need to make sure it has been at least 90 days before you apply for anything. Now, if you apply for a credit card and you get turned down, also wait 90 days before you reapply. The difference is when you do goodwill letters. If you're trying to get a late payment removed, banks don't do the 90 days. They want to see 12 months. That's the difference, okay? So it's usually 90 days for everything else. But if you're going to ask the bank to do you a favor, remember, they do more and they're quicker when they're doing something for themselves. But when it's you, it's completely different. So when you're asking them to give you a pardon and to remove that late payment, they're going to want you to have shown or demonstrated that you can make your payments on time for 12 months. All right. So remember that. The third thing, how many are there? Now, this could have 2 answers. How many are there? How many accounts show late payments, or how many late payments are on each individual account? They would rather you be late all at once than late sporadically. Let me give you an explanation. Say you have a Walmart, a Target, and a Sears card. Something happened and you just became 30 days late on all of them. Banks would rather, or they would be more understanding or lenient if they saw that isolated incident versus Walmart and Target been paying it on time, but Sears 30-day late, then you're good for 3 months, then another 30-day late, then you're good for 4 months. They don't like that sporadic. Why? Because they want to be able to look at you as a safe bet. And if they can see that, hey, this person has been paying their bills on time, they haven't missed anything, they've been a customer of ours for a long time, they got 1 30-day late, I think we can forgive that. Now, they can forgive that and give you that goodwill letter if you demonstrated the 12 months, or they can also forgive that when you're trying to apply for new credit. Some banks will understand and will approve you. Or if it's the same companies, they may still give you a credit line increase because, again, this was an isolated incident. That is the key word I want you guys to take away, okay? You can't see this on Credit Karma, but you can see it if you go to Experian, Equifax, or TransUnion. There is a section on your credit report that is called high-low balance factors. Real small, though. It's a really, especially on Experian, it's like really tiny, right? But it will tell you, or the bank, because a lot of us don't pay attention to it, what this person's been doing with this account in a 30-day period. So here's my example. Say you have a $500 credit limit on that Sears card. You move into a new place and you go shopping and you spend $450 on some furniture. Great. But because you're a credit whiz and you know that you don't want your credit score to drop, you pay it back down to $50 so that you can be under your utilization rate so that your score doesn't get affected and no one will know the wiser, right? Wrong. It will show on your credit report in the high-low balance factors section, 450 for the high, 50 for the low. So it's definitely going to tell you. Now, another thing about that high-low balance factor that I can't stand is if you happen to go over your account, say instead of $450, you charge $495, and you did not know that the interest rate was about to get charged the next day. So now you're over your limit. Then you get hit with an over the limit fee. So now that $500 limit is now $550. In your high-low balance factors, it's going to show the high for that month was $500. The low was the $50 because you paid it down. That's telling the bank still, this person has a problem with their utilization. You might not want to give them a loan. All right, so that is what the two things I want you guys to take away is the high-low balance factors and is it an isolated incident when it comes to your payment history, or actually when it comes to your credit period. But when it comes to your payment history, those are really the two biggest things they're looking for, okay? The second section, this is 30% of your score. It is the amount of debt. So it sounds really easy, which is so funny. It's 30% of your score, and it's also what they want you to have 30% utilization. They don't think we caught that, but we did. When you have an installment account, it's completely different. They do not take our installment accounts into consideration when figuring our utilization, because look at individuals who have student loans. Your student loans are all given to you. They're all unpaid. So right now, a lot of us would be way over 100% of our utilization just with things like student loans, okay? You're probably thinking, well, installment accounts don't have a utilization rate. They don't have a utilization rate that they're factoring into your score, but they absolutely have a utilization rate, okay? So if you borrowed $10,000 from the bank for a car, you paid $2,000 on it so far, you still owe $8,000, that's 80% utilization rate. That information is given to the bank. May not be for you, but it's definitely given to the bank. When you go to try to get a mortgage, they're factoring all that in because they want to know how high are you. Are you going to be able to handle more debt because you already have so much debt left available, even with your installment accounts, okay? So think about that with your student loans. You got student loans and you are in school, they're deferred. That's great. But if you've never made a payment on it, you're at 100%, guys. So no, you might not think that is important, but the bank absolutely does, all right? That's why when you go to try to get a house, that's why they only take 1% of what you owe for student loans, because before they didn't count that at all when they were letting people into these houses, and they didn't count the debt of the student loans, and then these people graduated from school and they were having these mortgages, and then the student loans were due, and then they couldn't afford. So they try to do it a little different now, but Please don't think for a second that your utilization is not accounted when it's in a installment account. It's just not factored into your credit score. All right. The next section, this is the third piece of the pie. This is a length of credit history, and it is 15% of your score. It is what it is. If you're an individual that was lucky enough to be an authorized user on somebody's credit card account and you're 26 now, well, you have 13 years of credit, okay? Because something's been reporting under that social security number. Although you couldn't view your credit report until 18, you still were accruing credit in the background, all right? When people start deleting accounts from your credit report, and I want to say this because you have a lot of people who are performing the credit sweeps and all that, and more power to your hustle. I have nothing to say about that, but what I will say to the individual that is paying for the service, if your oldest account is a student loan and you then wipe those student loans out, you have now taken your oldest age of your account and you've removed it, which has now hurt you because you've shortened your credit history. So now when you try to go to get a loan, this usually applies when you try to get a loan, banks really want to see that you have 5 years, more than 10 years. The older your credit is, the better. They want to see that you have 10, 15 years of credit building. Even if you screwed that account up and you have late payments and you have there's a charge off and it's horrible. That doesn't mean you're going to wipe it off. I would rather you remove the derogatory information and keep the account because it's going to hurt you, especially when you remove your oldest account. So a lot of times when people ask me, should I get this account removed? I'm like, I look at their credit and I'm like, no, this is the first credit card you ever had. You definitely don't want to do that. All right. So even when you file bankruptcy, don't remove those accounts from your credit report. Keep those accounts. That's the great part about bankruptcy too, is if you do nothing, you file your bankruptcy and you let your case, especially if this is Chapter 7, and you let your case get discharged, it's over. All of those accounts that you had, they don't disappear. The balance just now becomes zero. So now you have all that good credit history with nothing negative. Now, it may say included in Chapter 7. Well, you can remove bankruptcy from your public record section of your credit report. And once you remove that, you can go back and remove the remarks. I'll make that in another video. A lot of people don't know anything about that, but you definitely want to keep those accounts, especially if they're really, really old. You're going to need them. All right. New credit. This is number 4, the fourth piece of the pie. Or when was your last account open? Now, the great part I like about this is it's only 10% of your score. So when you open up credit cards, yes, your credit score will take a hit. But remember, once that credit is now extended and you get a credit line and all of that, I say after you've been approved for a card, you wait another 30 days, 30 to 45 days, and your score will go back up because now it has to refactor itself. So when people see their scores drop or the score increase, that's because the math has been done and it's refactoring. So don't stress if you open up a card and your score drops. That's just normal. It has to happen, okay? If you're an individual who you're going to add authorized users to your credit report or to your credit cards, to your credit file. You don't want to do one this week, one the next week, and one the week after. If you're going to open up and add 3 authorized users, you want to do them all at the same time. Why? Because you only want that 10% to hit once. And when it does its refactoring, you want it to just refactor once for all 3 accounts versus doing it 3 times individually. That is the same if you're applying for a credit card. If you're applying for a credit card and you just feel like, man, I'm at the mall today and Victoria's Secrets approved me and then I went to Macy's and they approved. If you're going to do things like that, you want to do them all around the same time, again, so that when the refactoring happens, it takes place all at the same time. That way your score can drop and do whatever it's going to do and look ugly, but then it'll go right back up and look good. If you do them all separately, you're going to have to wait till them to refactor each time. And to people who are really credit score conscious, it's going to drive you crazy, okay? Credit mix. That is the last piece of the pie. That's also 10%. This is, to me, and it's funny that they got it as 10%, but it, to me, should be up there with payment history and the amount of debt you owe. And the reason why I say that is because when you start for business credit, and a lot of people aren't necessarily on the business credit yet, but I hope that you guys who get your personal credit straight, that you will move over to business credit. Banks really want to see a healthy mix of items on your personal credit. They don't just want to see an individual that has nothing but credit cards and that's all, or nothing but credit cards and some student loans. No. Remember, the bank looks at you as a risk. Are you a good risk or a bad risk? And who doesn't like a stable individual, someone that has a mortgage, a home? Why? Because normally individuals who have homes and mortgages, if you look at studies and statistics, those individuals tend to be more mature. They tend to have more to lose, so they pay their bills on time. So the bank is more willing to extend you loans or high limits of credit, especially on the business side, because you're more stable. You look more responsible to them, okay? Another thing they like, and I know people say they hate student loans, and remember, they love to get them swept off their credit report, and I think it's the worst thing that you can do. Student loans are so important to your credit mix because if you can't pay Uncle Sam, you can't pay anybody. So if you have unpaid or late pays on your student loans, that should be one of the first things you guys get straight. Not just because they'll go and take your money from your tax return, but because banks are going to say, well, if you can't pay the person that we also have to pay, why are we going to give you any money? All right, think about it, folks. So student loans are very, very, very important to your credit. You always want to make sure those are in the green, not the red. That means even if you got to get on a payment plan, and they have tons of them, and you guys better get on them now because Trump's going to be changing some of these student loan repayment plans. A lot of them are going to go away. So if you haven't done it, you want to get on some of those ASAP. All right. The next thing that's important to your personal credit is a business loan. Now, no, I don't recommend people get business loans on their personal credit, but there are a lot of people who did not know about business credit and they started getting all types of things on their personal credit, and now they're just discovering that there's business credit. Banks still love to see that you have a business loan. Why? They look at business owners the same way they look at homeowners. More responsible. They're more stable. This person isn't going to just pick up and close this business because in order for them to give you a loan anyway, there's going to have so many things you have to provide the bank anyway. They're going to know that, hey, this person has a brick and mortar building. They're not going anywhere. We can stand the risk of giving them some money on the personal side, because remember, you didn't know about business credit. You can have a bunch of credit cards. There's nothing wrong with that either. But I want you to know that a mixture, that means installment accounts, which would be your mortgages, your student loans, your business loans, your car loan, your retail accounts. Okay. Remember the same accounts that I mentioned with the payment history. So your retail accounts would be your Walmart, your Lowe's, your Target. You have your credit cards, of course, your American Express, Visa, MasterCard. And, of course, if you went out and got any additional loans, that could also be looked at like a business loan as well. Okay. A credit mix to me is very, very important. And if you don't have those things, then I'm not saying rush out and go get a mortgage, but I want you guys to remember, if you're trying to have great credit and you look at the individuals who are wealthy now, they all own homes, whether they live in them or they're investment properties, or they know that real estate or a home, a mortgage is a part of the key, one of the keys to wealth. All right. So that you can have the best credit score possible. There are ways that you can definitely manipulate your score, but when it comes to the core things, these are the 5 core things that you need to make your score look great. So again, thank you guys for watching. Please like, subscribe, and share. I appreciate you guys' support. Thank you for tuning in. I'll talk to you guys soon. Bye.